Brian Johnson, is this environment good or bad for our banks? Because normally when rates rise, that's good, they get more margin.
Yep.
But is that right this time around?
I actually think it's undoubtedly bad. And when you actually go through, there's a number of reasons for that. But as interest rates rise, credit growth slows. The next one is, as interest rates rise, normally banks hold their deposit rates steady, so their net interest margins expand. But the problem is now you've got Macquarie have triggered a fairly significant pricing war in the deposit market space, so perhaps NIMs don't expand as much as we think. 60% of a bank's operating costs are labour, and we can now see these demands for really big pay rises because inflation is coming through. About 90% of 9% of bank lending that's been done has been done at greater than 90% LVRs. It's quite probable that house prices could fall somewhere between 15-25%, which creates negative equity, which means they might even have to increase their provisions a little bit more.
So we'll break down a few of those things shortly, but first, the major bank stocks are down between 13 and 17% since the beginning of May, which is when the RBA started hiking, versus a 9% decline for the ASX 200. Do you think the banks have further to fall?
Elise, when we actually have a look at it, the fundamental problem that we've got here is that about 30% of the home loan book was originated over the last 2 years when interest rates were really, really low, but when the Reserve Bank had been telling you interest rates would not rise till 2024. So what that means is a fairly big portion of the society here face a significant increase in their interest repayments one way or another.
You don't think the banks are well positioned for an economic downturn?
If I had to hide in one of the major banks, it'd be CommBank. But when I have a look at ANZ and Westpac, I actually think they're very poor quality franchises that get really hurt in this new environment going forward. But my messaging to clients is be underweight Australian banks.
What about Macquarie?
Well, Macquarie is very, very different. It feels to me as though this very volatile environment we're in is really, really good for their trading business. They really only had one quarter in the last result where the trading business had the benefit of all this volatility. And it just feels to me as though we're going to have a year of volatility. So I think the earnings numbers, consensus numbers on Macquarie are too low. But the really exciting thing is renewable energy. Macquarie controls about 10% of the world's asset infrastructure, and they've got about $13 billion of that is renewable energy assets, the equity. It's not inconceivable that that number could go from $13 billion to $13 trillion over the next 20 years. That is not in the share price. So I really like Macquarie. And the final thing is, a lot of the way to express this kind of rather miserable feeling I've got at the moment is by thinking that the A dollar probably continues to go down. Macquarie is positively leveraged to that because they make more of their earnings overseas than they do in Australia. So love Macquarie.
Going back to the mortgage issue and the fixed rate interest cliff that has been popping up here and there, how serious do you take that cliff risk, given that you say 30% of mortgages out there have been written in the last 2 years?
Well, really seriously, and just to explain why that is, the rate potentially goes from 1.9% to 6.74%, or it goes to the variable rate, which is 5.3%, and that will create stress.
It's going to create stress, but is it going to create a serious problem? Because there's a difference between going, we can't get the new kitchen that we were hoping, or is there we seriously can't afford this anymore. Well, I think we're going to have to sell.
You mightn't be able to sell. Just to go through.
But how do you define that stress?
Well, let's go through that stress. Is that when we have a look at it, the loan-to-valuation ratio, the high loan-to-valuation ratio lending that was done, didn't really go up over this cycle. So perhaps people were able to go to the bank of mum and dad and they were able to help them fund their equity component of their loan. But the high debt-to-income ratio lending has gone ballistic. It's gone from about 9% of the flow, peaking at something like 25%, which is a long-winded way of saying I was able to find the equity to put into my home, but I can service a much bigger loan because interest rates are so low. Now, when we have a look at where we head, interest rates are going up faster than income. That may well mean that perhaps the RBA cannot increase interest rates to the extent. Well, the problem with that is, If the RBA doesn't increase interest rates in line with what financial markets are pricing, presumably the A dollar weakens. And if the A dollar weakens, the price of every imported good goes up. So any way you cut it, we are in a real dilemma.
To what extent can banks control the extent and speed at which house prices fall? Because obviously, with 60% of their lending in housing in Australia, they've got a bit of an interest in it not going too far.
Well, they probably do, but it's not apparent to me how you can avoid the fact that certain households have geared the daylights out of their incomes to buy very expensive houses. At least something's got to crack here. Like, nothing fits together anymore. So what happens? Massive disruption. I think a recession is inevitable.
And can the banks do anything to soften that? Will they be able to do anything?
Yes. When we actually have a look at it, the way bank loan loss provisioning works is that you don't provide for what is actually happening at the point in time. You provide for scenarios of what might happen. And right at the bottom of COVID, banks provided a lot for scenarios whereby house prices were going to fall a lot. So it depends very much bank by bank.
Brian Johnson, we could talk all day, but thank you very much for your time.
Thank you very much. Thanks, Elise.